Good morning, ladies and gentlemen. I'm Hamilton van Breda. I look after retail sales at M&G here in South Africa. And with us this morning, I have got Alex Araujo, who joins us from the London team, one of our colleagues. He joined M&G's income team in July 2015, and he is named co-deputy fund manager of the Global Dividend Fund. He is also the appointed manager of the Global Listed Infrastructure Fund, and that's a fund that we are going to talk about this morning and the strategy behind it. He's also the appointed manager of the M&G Global Themes Fund, which he joined in January 2019. So I'm going to move forward, and as I said, we're going to look at the philosophy, the process, and some insights on the Global Listed Infrastructure Fund. The fund was launched in 2017, and Alex was responsible and created the idea of bringing this particular strategy and fund to the market. So, Alex, maybe where we can start is if you can give us some insight as to the philosophy and process of the team and the fund.
Sure. Thanks, Hamilton, and hello, everyone. The philosophy around the strategy is simply to deliver growing cash flow streams to our unit holders that are backed by companies owning strategically advantaged physical assets, critical infrastructure assets, long life concessions, and perpetual royalties, where the physical asset is actually land holdings. And what's unique about this approach is that you've got these advantaged businesses, companies, assets that have some kind of competitive superiority over any potential competition, typically, which gives them the ability to generate those cash flow streams that grow over a very long time period. And that's very key. It's a long-term investment horizon strategy, and we have an objective to grow income to our unit holders every year.
So you spoke about growing that income. You used income, and you spoke about cash flows. You spoke about dividends. What are you trying to achieve in respect of that dividend growth? And I have put up a slide that I know that you've used in the past.
Mm-hmm. Well, a lot of people think of infrastructure investing, or property investing for that matter, as a high income type of a strategy. And it's true, you can get high income. But typically when you get those high dividend yields, they tend not to grow. And so we're not tempted by what we see here in terms of the green bars, the high dividend yields with no growth. We're willing to accept a lower starting dividend yield, but see those dividends grow over time, so that when we look further out into time, when we're thinking about retirement and our spending needs well into the future, we're actually achieving higher cash flows, higher dividends. And that's particularly important in an inflationary environment, because we need to offset the rising cost of living.
If you look at your portfolio as a whole, Alex, I think everybody would ask is where are you investing? You want to bring that asset class to the sort of modern age. How do you define that listed infrastructure when you typically build your portfolio?
Yeah. Well, traditionally, infrastructure centers around three very familiar categories to most people when they think of infrastructure. Utility businesses, so our electricity, our water supply, so on. Energy infrastructure, which are the pipelines, the storage facilities that serve the energy industry. And transportation infrastructure, which I would think all use: toll roads, public transit, railways, airports, and so on. But also ports that bring in goods and export goods in various places. And that's all good and well, and that's a very important aspect of the strategy. It's core to our strategy, and what most listed infrastructure funds focus their energy on. But we expand our definition and the breadth across which we invest to social infrastructure, which is of course critical to the functioning of society. It's things like hospitals, state care facilities, life sciences infrastructure, and civic infrastructure, municipal buildings, libraries, courthouses, schools, things like that. And these are very defensive elements of the portfolio, and tend to have a guaranteed revenue stream from governments, typically. for which the infrastructure is provided. And then we get into the really exciting area, what we call evolving infrastructure, where we get high rates of growth, structural growth typically, from areas of infrastructure that are serving the modern world, digital infrastructure in particular. So if we think of how commonly we use the digital equipment at our fingertips for Zoom calls, for telephone calls, for gaming, for entertainment, and so on, and of course mobiles, we need towers, we need data centers, we need fiber optic networks. And this digital infrastructure is physical, and it's critical to the functioning of this increasingly digital society that we work in.
Makes it quite clear. And then if you have a look at those infrastructure classes, so you spoke about economic, you spoke about social, you spoke about evolving. How different is that when you compare, your strategy and fund to that of our competitor funds?
Well, what's unique about this approach is that typically the constituents of each of these categories move in different ways versus each other in different market environments. So if economic infrastructure is doing well, it might mean that social infrastructure might not be doing as well, or evolving is doing very well and another area might not. And of course we have the various sectors within them. And what that allows us is to take advantage of opportunities that the market delivers. This is a listed strategy, so we're operating in listed equity markets where prices are changing all the time. And it's our ability to rotate capital around the various sectors, categories, and even regions to take advantage of opportunity that makes the strategy unique. And that's given us an advantage versus our peer group over time.
Okay, so if we talk about that advantage, so how many stocks roughly would you have in your portfolio at any given time?
Yeah, it's a relatively concentrated portfolio of between 40 and 50 holdings. Yeah. Today we have 46. Yeah. And it might surprise you that after 6.5 years of managing the fund, most of the holdings that were there on day one are still in the fund. It's a buy and hold, long-term minded investment strategy. That's not us being lazy. That's us identifying high-quality businesses and sticking with them. We might change our position sizes. That's what I'm talking about when I refer to the rotation of capital, to take advantage of valuation opportunities over time. And that's where we're mostly active in managing the fund. So
I like the fact that you use the word lazy. So let's just talk about that for a second. Do you limit yourselves in terms of your size exposure as a percentage to a particular stock?
Yeah.
So, and then if maybe you can talk us through, you spoke about the sort of evolving or rotating out of a stock completely, or just maybe?
Yeah, so we have a typical minimum position size of 1%. That means we like the story, we believe in the company for the long term, but the valuation may not be as attractive today as it might be in the future. And if it does become more attractive, we can increase our position size to typically a maximum of 4% to avoid too much single stock risk.
So if you're at a maximum of, say, 4, it obviously may drift over time, but you would, where there are opportunities or if a sector has underperformed and you see value in that sector and there's opportunities, you would maybe cut from your 4% and add to the 1.
Yeah.
So you're not, so this is what you mean by rotating.
By rotating, exactly.
Not really selling out of the stock entirely.
No.
It's the, and is that the core of what you do every day?
Yeah, that's exactly right. And we will sell holdings if the investment case changes, if the dividend growth disappoints us, if there's poor governance, if there's an issue with assets. And we have done that over time. We're not perfect. We can get things wrong. And so we will divest, and we will put new holdings in the fund, typically companies that come to market or companies that have suddenly become very attractive to us.
So if you look over time, my understanding is that the sort of utility sector is, by its very nature, quite defensive. How has the strategy performed in very difficult markets, such as 2022?
Yeah.
What's your downside been like?
So the one of the features of this asset class and this strategy is its ability to preserve capital in difficult market environments. So if we think back to 2022, which now feels like a long time ago, it was a very, very difficult global equity market environment, with the market down 18% in US dollar terms, more than 18%. And the strategy preserved more than half of that capital. Now, it's no fun losing 9% in a year, but it's a lot better than losing the 18%. And that's an important feature of the strategy, is its ability to preserve capital. And in 2022, the utility sector was instrumental in delivering that downside protection. And it's worth pointing out that utilities are quite prominent in this strategy. They represent roughly 20 to 40% of the strategy. Today it's about 30%, which is less than a typical infrastructure index, but it's still very prominent.
Okay. So 2022 was it a tough year?
Mm-hmm. For the market.
2023, we saw a bit of a recovery.
Big recovery.
We did notice from the numbers. People do look, and unfortunately, investors are a bit short-term focused. But you did lag.
We did lag.
The markets.
Yep, we did lag. The market was focused on very exciting things, as we all know. The concentration of market performance was very much in a couple of sectors, and in fact in mainly seven stocks. And it left behind a lot of these businesses that are very attractive, still delivering against expectations, and therein lies the opportunity. So it's really the market focused on other things.
You know, when you're looking at a strategy like this, many investors would ask the question, you know, what percentage exposure should we have to this kind of strategy?
Mm.
And also to take it one step further, it's really two questions, is what are the prospects of this fund? What are your real prospects? Why are you excited about it, particularly now?
Yeah, we're excited because we think long term. And we have businesses in the portfolio, such as utility companies, that are able to consistently compound their earnings, their cash flow, and their dividend growth because of the nature of their businesses and their assets. And the market doesn't appreciate that currently, and that's fine. We understand that. We're opportunistically taking advantage of that opportunity. And so the long-term prospect for the strategy is really that consistent compounding, the delivery of dividend growth. And let's not forget, we also get a dividend yield from the strategy, which is well above the market dividend yield. So today it's about 4.25%. And if you add the growth to that, you start to come up with a high single-digit expected return, plus whatever re-rating that we're able to achieve from the market, finally valuing these businesses the way they should be.
DFMs, multi-managers, category 2 type advisors, sophisticated investors, when they build their portfolios, they often look at correlation matrices. How does our fund behave relative to, say, other global equity funds in their portfolio? Based on what you've said so far, it would seem that be quite different. Yeah,
it is different, and you can see that from the performance in 2022. You can see that from the performance in 2023. It's a specific asset class. Yes, there's equity market volatility. There's no question about that. But this is an asset class that tends to move differently from the broader equity market. The volatility is lower. The beta is less than 1 for this strategy. And of course, you get that drawdown protection in difficult market environments. Typically, that's been our experience.
So it would effectively complement a decent global equity portfolio?
We would think so. A lot of our clients are making a permanent allocation to the asset class. When everything's going well in other sectors, it still delivers you that nice dividend yield and dividend growth. So it's doing its job. And then when the market has a difficult period, it can be very helpful in protecting capital.
So I notice on this portfolio that your benchmark is the MSCI or Country World Index.
Yes.
And I think the question would be, is how do you build your portfolio of stocks?
Yeah, it's all bottom up. We designed an investable universe many years ago that consists of 270 odd companies with $3 trillion in collective market cap, and we select them on a bottom up basis. And so we're aware of the benchmark, but we're not obsessed by it, and we don't aim to track to any particular geographic or sector weights. Obviously, there are sectors that are not represented in this strategy. They're represented in the market. And we are disproportionately more represented in things like utilities in this strategy versus the global equity market. You know, it's interesting. The global equity market will have something like a 2% weight in utilities. So global fund managers don't spend a lot of time on them. They'll either own 1 or 0 of them. Whereas we're very focused and very specialist in looking at that sector. And we'll have, as I mentioned earlier, more than 30% of our exposure. So we don't track by sector. From a geographic point of view, it's mainly developed market construct, roughly 60% North America, and most of the balance is UK and Europe, with a little bit in Asia as well. So it's the result of a bottom-up, really.
Okay. So, I mean, that does make sense. So if you look at the output of your portfolio and you break it up in terms of country and region or industry, as you said, it's a function of your bottom up. It's got nothing to do with your benchmark.
No, exactly right. And we don't take a macro view. We don't try to predict interest rates or inflation or Fed policy. We're fundamental investors.
So then why do you use equity? Why
not
any other?
Yeah, there are listed infrastructure indices,
Yeah.
but when we looked at them, they didn't resemble in any way our approach. There were sectors that were overrepresented, disproportionately so. Sectors that weren't represented where we invest, such as social infrastructure and so on. And so we didn't want to have a benchmark that would corrupt our decision-making process. We also see this strategy as a complement to global equity portfolios. And so we're aware that the global equity market is what it is, and that we can be complementary and we can be an alternative, in fact, for some people. Some of our clients see this as equities for beginners, core equity in a sense, because how do you argue with an enhanced dividend yield, growth in income every year, which is one of our objectives, and the potential re-rating? That gives you a very good outcome with lower volatility and lower drawdown than the broader market.
The fact that you rotate your stocks through the sort of three very different areas of this particular strategy leads me to think that, I mean, you're obviously a long-term investor, you're an equity investor, but what are the returns of this type of strategy over the long term? Yeah,
well, the starting point is the dividend yield. Today it's 4.25%. And then you get the typical growth of between 5 and 10%, and the utility sector is a perfect proxy for that. Where if you look at the last 20 years, yes, there's some cyclicality, but the utility sector generates more than an 8% compound annual return because of that consistency and reliability of it in dollars. Exactly right. And that's pretty amazing. That's a pretty consistent.
I'll take that.
We'll take that. And so when we look at that, we see very good prospect for growth. And of course, we're not just buying the whole sector. We're buying the ones that we like the most, that have the structural growth.
We run a fund here in South Africa called our Dividend Maximizer Fund, and we got a local equity fund, and we've got just a normal general equity fund. And when we speak about returns or the composition of returns, we often break it up between dividend yield, earnings growth, and re-rating. Mm-hmm. Now, if I look at your fund and you concentrate on income and dividends, then what can you expect from your fund? How would you describe it if you were to sort of in exactly
the same terms? So we would focus on dividend growth as an expression of earnings growth, obviously, starting with a dividend yield of about 4.2%, plus growth of between 5 and 10%. That gets you easily into the high single digits. And then the rating is really up to the market. Yeah. We've had a year where this fund has delivered a 37% return versus a market that returned less than that. So there is the capability of that re-rating to be a powerful component of the total return.
Fantastic. I would like to end off with, just for the investor base, I think many of our investors who can relate to infrastructure type investments probably like to understand some of the sort of long-term themes that you're looking at.
Yep.
Maybe give us some insight into that.
Yeah, and this is what keeps us honest, Hamilton. This is why we're here. We're seeking to capture the long-term opportunity of structural requirements for infrastructure around the world. And the people of South Africa are very familiar with the importance of energy security and the need for renewable energy and the energy transition, and that is a key theme, as is transportation of the future, and in particular the electrification of transport. Emerging markets in particular are focused on infrastructure for increasingly urbanizing areas. And then universal connectivity. Where would we be without our digital infrastructure? Life would be very different. A more circular economy requires things like water and waste management. And then when we think about social infrastructure and demographics, we get into themes surrounding healthcare infrastructure and other types of infrastructure assets to serve a changing population, a changing demographic.
I have one last question for you. Where's your own money invested?
I was the first investor in this fund with 100% of my pension, my self-directed pension. So I have the pleasure of managing my own retirement funds along with everybody else's.
It's great to hear. Alex, really want to thank you for your time. I hope you enjoy the rest of your time here in South Africa.
Thank you.
And for our listeners, just please note that the Lux Dollar Global Listed Infrastructure Fund is available on the majority of global platforms. And recently, we also established a Rand feeder fund. We are still trying to get them onto all the platforms. They are on a few. But if you want some more information on this fund, please don't hesitate to contact our client services, get hold of your business development managers, or simply talk to your financial advisors. Thank you very much for your time this morning.